A profound mechanical tension is building inside the XRP ecosystem. We are tracking a severe contradiction between expanding real-world utility and exhausted price action. This tension is amplified by the broader market conditions. We are operating in a climate of high risk aversion, with the Fear and Greed Index at 16 out of 100 and Bitcoin dominance at 57.1%. This visualization captures the discrepancy. On the left, XRP's price action is hovering at $1.341.7. On the right, we track the explosive growth of on-chain metrics. Look at the raw utilization. The Layer 1 network's active user base has multiplied tenfold. Almost 3 billion RLUSD stablecoins have been minted, a massive increase from the previous 200 million baseline. Yet, despite this liquidity, the institutional technical score for XRP is just 25 out of 100. By these metrics, it remains a high-risk asset. The market is currently ignoring the fundamental on-chain data. For traders operating strictly on ledger growth, this creates a significant analytical gap. We must identify the specific technical friction preventing this tenfold network growth from reflecting in the price before we can project the next directional move. The daily chart reveals the macro structure. The 200-period EMA sits far above at $1.9514. The vertical gap indicates persistent selling pressure. On the 4-hour timeframe, price struggles beneath the Ichimoku cloud resistance. The MACD confirms this with a bearish crossover and negative histogram. The critical metric is liquidity. Volume has collapsed to just 11%. In institutional trading, 11% volume signifies a total absence of buyer conviction. Without volume, minor bullish price bumps lack sustainable strength. The average directional index sits at 17.53. Since this is well below 25, it confirms the current trend is lethargic and lacks directional strength. Without institutional volume, retail buying alone cannot push the asset through the technical resistance zones overhead. The macro structure creates a ceiling of risk. To find signs of short-term survival, we must zoom in to the 1-hour chart. This 1-hour chart maps immediate boundaries using a Keltner channel. Price is locked directly on the median line. While slightly bullish, volume lingers at 64% of average. Zooming out reveals the primary barrier, the historical downtrend line from the $3.66 peak. This line intersects current price action exactly at the $1.47 resistance zone. An advance to $1.40 or $1.46 is statistically irrelevant if it fails to move through that $1.47 limit with force. A true reversal requires an aggressive push through $1.47, a climb to $1.50, and a pullback to confirm that former resistance is now acting as support. Below current price action sits the historical support floor at $1.11, established during the sell-off on February 6th. There is a risk in being entirely out of this asset right now. If the downtrend line breaks, the asymmetry created by 3 billion stablecoins will likely trigger a sharp move upward. However, entering before the $1.47 validation is equally risky. A failed breakout could lead to a retest of the $1.11 support floor. XRP is technically strangled. It must either break the historical downtrend line with significant volume or yield to the macro gravity. This terminal view strips away the indicators to reveal the raw statistical probabilities derived from our analysis. We assign a 50% probability to the bearish scenario. If the asset fails to hold the $1.33,048 support on this low volume, the targets shift to $1.32,018 and $1.29,049. There is a 20% probability for the neutral scenario, where the price continues to move sideways between $1.33,048 and $1.36,096. The bullish scenario holds a 30% probability, requiring a volume-backed breakout toward $1.38,098 and the $1.46,661 level. Given these skewed probabilities, the executive decision is clear. The official recommendation is to wait. Taking a position now without volume confirmation is mathematically unsound. Keep observation focused on the range between 1.3348 and 1.3696. For those who execute once a breakout is validated, a stop loss must be placed at 1.3218 to protect capital. The take-profit targets are 1.3898 and 1.4661, maintaining a risk-to-reward ratio of 1 to 2. The validation condition here is absolutely mandatory. We must see a significant spike in volume above the moving average. The network explosion and the influx of 3 billion stablecoins suggest that this structural asymmetry will eventually resolve with force. But trading the chart today without volume validation is a matter of hope, not professional strategy. Wait for the market to prove its strength.